Everyone is telling you that real estate is the only way to build wealth. They're wrong. At least, they're wrong for 2026. If you sign a mortgage today based on 2024 logic, you aren't buying an asset, you're buying a financial anchor that could drag you down for the next decade. Today, we're looking at the brutal math that proves why waiting isn't just a choice. It's the only way to survive the 2026 market shift. Here's the number that should stop you cold. Home builders right now are sitting on 9.4 months of unsold new home supply, almost double what a healthy, balanced market looks like. Builder confidence itself just registered at 37 out of 100, where 50 is neutral. The people building the houses don't even believe in this market. And yet, in cities like Hartford and Rochester, homes are still getting multiple offers in a week. That contradiction is the whole story. And almost nobody is doing the actual math on what it means for you specifically. By the end of this video, you'll have the exact 4-part test I use to know whether a house is a trap or a trade, something no other channel is breaking down with this level of real data. Let's start with brutal math number 1, the rate that isn't going anywhere. As of late May 2026, the average 30-year fixed mortgage sat at 6.53%. Most major forecasters, Redfin, Realtor.com, Veros, expect 2026 to average somewhere around 6.2% to 6.3% for the full year. Nobody serious is forecasting a return to 3% or 4% mortgages. That era is closed. If your 2024 logic was buy now, refinance later when rates drop, you're not buying a house. You're making a bet against the bond market, and right now that bet is losing. Here's the part that makes this worse than it looks. An estimated 80% of mortgaged homeowners in America are sitting on a rate below 6%, many of them locked in at 3% or lower from the pandemic refinancing wave. Picture someone who bought in 2021 at a $2,400 monthly payment. They'd love a bigger place, new job, new kid, whatever the reason. But moving means trading that payment for a new one, on the same kind of house that could run $3,800 a month, just because of the rate. That's a $1,400 a month tax for the crime of wanting to move. This is called the lock-in effect, and it's why inventory has stayed artificially frozen for 4 straight years. The starter homes and family upgrades that should be hitting the market simply aren't, because selling is financially irrational for the people who own them. By the way, if this is landing for you, subscribe. The algorithm doesn't push videos that challenge how people think about money, unless viewers actively tell it to. Brutal math number 2. Builders know something you don't, and it's sitting in plain sight. While existing homeowners are frozen, builders kept building anyway, and now they're stuck holding it. As of April 2026, there are roughly 489,000 new single-family homes for sale nationally, 9.4 months of supply, against existing homes at a comparatively tighter 4.4 months. A half-finished house earns a builder nothing while it sits there, which means builders are discounting hard, just quietly, in ways that never show up on the listing price. Lena reported 2025 incentives averaging roughly 13% of the home's price. On a $400,000 home, that's about $52,000 in rate buydowns and closing credits, baked invisibly into the deal. Nationally, 64% of builders are offering incentives, and 37% have cut prices outright. Meanwhile, D.R. Horton, the largest home builder in the country, slashed its unsold inventory 25% since December by simply building less. Remember this sentence. In 2026, the listing price on new construction is an opening offer, not a fact. The 2024 version of you would have walked away from that price. The 2026 version of you should be on the phone with the builder's sales office, asking what they'll actually take. Brutal math number 3. And this is the one that explains the anxiety you've been feeling for years, without a name for it. Since 2020, home prices nationally have risen by roughly 50%. Incomes, over that same stretch, have risen by about 29%. A 21-point gap between what homes cost and what people earn doesn't close in one good year. And it didn't open because of one bad decision you made. It opened because the entire game changed underneath an entire generation of buyers. And most of the financial advice circulating right now still assumes the old game. Brutal math number 4. There is no such thing as the housing market anymore. and treating it like one is how people make six-figure mistakes. The Northeast and Midwest, places like Hartford, Rochester, and Worcester, now dominate the top of the best markets list for 2026, a complete reversal from a year earlier, when the entire top 10 was Southern and Western. Less new construction, tighter inventory, steady local labor markets. Prices there are forecast to climb another 3 to 4% this year, on top of everything already baked in. Meanwhile, across the Gulf Coast, Texas, and Florida, the pandemic migration wave has slowed hard. Insurance costs in exposed areas have spiked, and inventory is piling up. In markets like Port St. Lucie, Florida, prices are now falling year over year. Zillow's national market temperature sits at a deceptively calm 55 this spring, a number that hides two completely different climates underneath it. If this video is giving value, kindly hit the subscribe button. We want to hit 1,000 subscribers before the end of June. Help us get there. Let me make this real with two people. Call them Mara and Devon. Both 31, both first-time buyers, both with around $70,000 saved and similar incomes. Mara is shopping in a mid-sized Texas market. Devon is shopping just outside Worcester, Massachusetts. Mara walks into showings and finds listings sitting for months, with price cuts stacked on top of each other. Inventory near her is actually above pre-pandemic 2019 levels. The brutal math works in her favor. She can negotiate, demand repairs, walk from a bad inspection without panic, because there are 4 more houses just like it down the road. Devon walks into a bidding situation by Sunday night on anything reasonably priced, because his market never got the inventory relief Mara's did. For Devon, wait for a deal isn't a strategy. It's a way to watch the price climb another 3% while he stands still doing nothing. Same year, same national headlines. The brutal math produces two opposite correct answers. This is exactly why should I buy a house in 2026 is the wrong question, and why blind 2024 logic, real estate always goes up, just buy something, is exactly the kind of thinking that turns a house into an anchor instead of an asset. So here's how you actually run your own brutal math before you sign anything. 4 questions, in order. Question 1. What's the actual months of supply in your specific metro, not the national number? Above 6 months, you have leverage. You can be patient, negotiate, walk away. Below 4 months, you're in seller territory, and wait and see costs you money every month you sit on it. Question 2. Is the home new construction or resale? If it's new construction, the listing price is not the real price. Call the sales office directly and ask specifically about rate buydowns and closing cost credits before you do anything else. Builders are negotiating harder in 2026 than the headlines suggest, and most buyers never even ask. Question 3. What's your actual break-even on renting versus buying, given that shelter costs are inflating at 3.6% annually, faster than overall inflation? If your rent is climbing at or above that pace, and you're staying put 5+ years, the math increasingly favors locking in a fixed payment now, even at 6.5%, because rent has no ceiling and a fixed mortgage does. Question 4. The one 2024 logic buyers always skip. Can you actually afford this if rates never drop again? Every forecast for this video, Redfin, Realtor.com, Knob, JP Morgan, agrees on one thing. Nobody credible expects rates back in the 3 to 4% range. If your plan depends on refinancing your way into affordability later, you're not buying a house. You're gambling on the Fed. Here's what the brutal math actually adds up to. The old advice, real estate always wins, just get in, was built for a market that stopped existing years ago. Builders are drowning in unsold inventory. Rates aren't coming down to rescue anyone. The price-to-income gap from the pandemic hasn't closed. That's the anchor. But the same math also shows that in dozens of metros right now, sellers have lost leverage they haven't had in years, and builders are quietly handing out tens of thousands of dollars to anyone willing to ask. That's the asset, hiding in the same data. The difference between the two isn't luck. It's whether you ran the brutal math on your specific 15-mile radius before you signed, or whether you bought on 2024 autopilot and hoped. You now know which 4 questions separate those two outcomes. If this just changed how you're looking at your own market, subscribe. Because next, I'm walking through the exact negotiation script to use with a builder's sales office to pull that hidden incentive money out into the open. I'll see you in that one.